Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. During the first two segments, if you missed it, we were talking about some tax strategies and some tax planning, some tips for you that we do in our firm, and hopefully it's some use to you for those of you at home that do it yourself. We started moving into some investment type planning things that I want to discuss. One is, you may have heard the term optimal portfolio, and you have stocks and bonds and commodities and real estate, and how you combine those into a portfolio. You know, a lot of advisors and there are websites out there that are saying, well, we've designed, the optimal portfolio, and you may have heard the term the efficient frontier. And a lot of this comes out of the work in the 1950s of a guy by the name of Harry Markowitz, who developed this concept of the efficient frontier and capital market lines and things like that, where the theory of combining different asset classes, you can actually achieve the same return at a lower amount of risk. And the theory is great. The theory is 100% correct. And his big thing was that diversification is a valuable tool when designing a portfolio. So thanks to increased computing power, it's amazing to think when he developed this theorem, computers, it would take, literally days to solve very simple optimal portfolio allocations. Now you just click a button and you can have, you can analyze millions and millions of data points and come up with these optimal portfolios. And so you have financial advisors and websites and places, touting, oh, we've developed the optimal portfolio and the efficient frontier and the perfect mix of investments. And what we see is that the inputs to an optimizer are so sensitive that slight changes in what you need in an optimizer to compute an optimal portfolio is you need a return number. So you need a return estimate for each asset class, like stocks, bonds, real estate, commodities. You need a standard deviation number, which is just simply measures the volatility. How volatile is that asset class? And then the third input you need is a correlation estimate. And what that does, it looks at two assets, and it's a number that describes how they move in relation to each other. So two perfectly correlated assets, a correlation of 1, they both go up at the same time. Now, it doesn't mean they go up at the same rate or the same amount. It just means that when they go up, they both go up at the same time. Or a -1 correlation is that when one goes up, one is always going down. And so those are the three inputs to an optimizer to try to figure out the optimal portfolio. And what we find is that the inputs are very, very sensitive, that standard deviation, the volatility is probably the most stable. That's kind of funny. The volatility is the most stable input to an optimizer, although they do vary. Of course, any of you that were investing in 2008 remember the spikes in volatilities. But the return estimates, of course, are all over the map. And the correlation between asset classes also changes over time. And so what you see is that a lot of times advisors will just put data in there, and they'll come out and they say, well, you should have 90% of your money invested in emerging markets, simply because they did the best. And then they say, well, that's not really realistic, that's way too much. And so then they'll put a constraint, well, a maximum of 10% in an asset class. And then they'll see that something like maybe tips falls out of the efficient mix. They say, well, we want some tips in there. So then they put in, you must have a minimum. And so what happens is this optimal portfolio really, in the end, is simply the advisor or the website, whoever's running it, it's their own interpretation of what a good portfolio is because they have altered the data so much. And so my point in going through this whole description is that the optimal portfolio is really a myth, and the optimal portfolio can only be determined in hindsight. And let me just say that again. The optimal portfolio for any given time period can only be determined in hindsight. So anyone that is saying, well, this is the optimal portfolio, they don't know that. It can only be determined after the fact. And in fact, we see it. There's some great studies where they take an optimizer and they run the data, say you're January 1, 1970, and they look at the historical data and they say, okay, well, this is the optimal portfolio going forward for the next 10 years. And then, in 1980, they look at the data for the prior 10 years. And so they look at constructing an optimal portfolio for the next 10 years. And it's never the optimal portfolio for the next 10 years. Looking at, what happened historically, and it's because a lot of them rely so much on the historical return, the historical correlation, or the historical volatility. So be very skeptical of these, what I call black box solutions that claim to have created the optimal portfolio for the future. Now, I'm not saying it's a completely useless exercise. I think it's very important to try to develop some of those things. As I mentioned, volatilities certainly change over time, but the relationship between them is fairly stable. For example, you can generally assume that stocks are going to be more volatile than bonds. Now, long-term bonds are going to be more volatile than short-term bonds. So some of those relationships are somewhat stable. Correlations certainly do change over time, and returns, estimates of returns are one of the inputs. And so, but by trying to estimate some of those and putting some common sense factors in there, for example, don't put 95% of you, just because the computer said to put 95% of your money into, Thailand stocks, put some common sense on that when developing your portfolio. So we just want to caution you against these black box solutions that purport to claim that they have developed the optimal portfolio. The principle of efficient portfolios, optimal portfolios, is valid. Diversification, looking for asset classes that tend to move one direction in opposite directions, or don't move all in the same direction at the same time. For example, saying that you have U.S. large cap stocks and dividend paying stocks and large value stocks and 12 different kinds of U.S. stocks is not diversified, is a suboptimal portfolio. So it's really not possible to determine the optimal portfolio unless you're looking, until after the fact. But we still think it's a useful exercise if you know what you're doing to create a diversified portfolio that has a better chance of meeting your goals. Well, that's all the time we have for today's show. I hope you enjoyed it. Talked a little bit about taxes, a little bit about investing, and hope that you'll join us again next week, where we'll have some more interesting topics.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.